I know in talking about condo insurance, you said there's been a lot of changes in recent months. And I'm curious, what is the impact it has on residents and the condo associations in general? And what do realtors need to know working with clients?
Well, I think where all of this started, and people are even seeing it in their home insurance, is in Minnesota, we have very high amounts of hail, and we've paid out a lot of hail claims, especially in 2022 and 2023. There are a lot of roofs replaced, and it was a huge cost to insurance companies. And now you've got an association master policy that may have changed all their roofs and had to make that claim. And then a couple, there's always going to be individual units that may have a water claim or something else. But now it all bubbles up because there's these multiple claims. And so now associations are running into trouble where they can't afford the renewal premiums. Mm-hmm. They are getting non-renewed for their policies and then going out and having to find different insurance policies that now will only offer so much coverage in different areas. And so because of this, it's showing up at the, blending process. It's showing up when it comes to us trying to insure their condo, their own HO6 policies. Mm-hmm. And I think Jordan and I could probably give a couple examples of situations that we've seen come through. I don't know if there's something that you've seen that's hung up a closing
Yeah. We've had it increasingly happen this past year, and I'm sure even more going into 2025, just as a result of all the natural disasters that we've had throughout the country. But we've seen a lot of, well, I shouldn't say a lot, but we've seen issues arise in the lending side of the home buying process where a property owner is unaware of the changes in their condo's master policy, and the listing agent maybe is unaware as well of the changes that have occurred within their master policy insurance. And it's not something that typically you go and review first thing right off the bat is the master policy. But it's really important to take a look at them because we've seen a lot of items come up on the back end that have caused issues for listings, for buyers wanting to purchase homes where maybe the coverage in the master policy only covers the actual cash value of the roof on the property. And this came up this summer because this association had recently changed their coverage, and they had never had a sale since they changed their coverage to the actual cash value policy. And so the association, they're a very small association. They're looking to cut costs as much as they can. And so one of the best options for them to do so was to take insurance policy that covered the roof with actual cash value. Lenders and Fannie Mae, Freddie Mac, FHA, HUD, they don't accept policies, and they can't approve master insurance policies that have actual cash value replacement coverage for the roof because it's a liability, right? Who knows what the cash value of the roof is currently and how much is the replacement going to cost, and are these homeowners going to be able to afford that? And so actually it was in, I believe, June of 2024 that Fannie Mae made the switch over following the footsteps of FHA and Freddie Mac to not allow ACV coverage on master insurance policies. And so that came up as an issue for us this summer.
Right.
And we didn't end up closing the loan because the association leadership wasn't willing to change the coverage. They couldn't get the votes because it was going to be more expensive for the homeowner.
Wow. So could only a conventional loan go through in that?
No traditional financing was able to be used against the property. We couldn't find an FHA route. The property wasn't in a USDA eligible area. Potentially they could have done VA. Our buyer was not VA
and so this is like any approved listing, anyone trying to sell now
anyone in that association trying to sell was not going to be able to sell it to anybody using traditional financing. We could have maybe had the homeowner had the ability to increase their down payment, gone through a non-traditional financing route, but then it would be called, we call them non-insurable condos, basically, and that means it can't be insured on the secondary mortgage market. So we would have to hold that mortgage in-house. because it can't be transferred off to the insuring bodies of Fannie Mae, Freddie Mac.
I mean, that's a huge learning lesson that obviously
Right.
is new. How can people be prepared? And it sounds like, read through the policies, find out where they stand, but what else can they be doing, or what should they be watching for?
Well, I mean, ultimately, it is getting a copy of that master policy and finding out what it covers. That's the first thing that I do whenever I'm doing any, quote for condo insurance. And the sooner the better. I had a lender reach out to me a week before closing, and they had just found out that their insurance company for the association, American Family, non-renewed the townhome policy, and they couldn't find a new one. So they just added this quick blurb on their disclosure that said, basically the buyer has to get their own policy to cover the entire structure. Wow. So we had to actually write a homeowner's insurance policy for this buyer. And, a condo insurance policy, maybe $600-800 a year. A homeowner's insurance policy, his company he had was like $2,700. It was looking to, and that's a big cost. We did finally find something closer to about $2,000, but all of a sudden you've got that extra amount added into your loan. How a week
your
before closing.
Payment, yeah. And a lot of times right now we're seeing buyers on the market kind of, pushing their budget up to be able to get into a home that they feel comfortable in. And so when you have a situation where you've got a borrower whose DTI is not going to allow for a $600 a month insurance policy, we got to really make sure we're looking at those things on the front end. And that's the biggest piece of advice that I could give to real estate agents and other real estate professionals as we go through into 2025 is to be reviewing our master policies, sending them to your insurance agent proactively, but also sending them to your mortgage lender proactively. Because if it is a true condo unit, that's going to have to go through underwriting specifically for the condo. And our underwriters are going to very intricately look at that master policy to make sure that it's going to be approvable on the secondary market. And increasingly so, we've seen issues come up on that.
And, with insurance, what's happening with all these changes in the master policy is this coverage is getting pushed to your own HO6 policy to pick up. Okay. A lot of it comes in this loss assessment coverage. You had mentioned earlier that, that condo insurance policy can cover, the interior structure, their personal belongings, also has liability coverage. But now the biggest, almost most important coverage that's coming to light now is the loss assessment coverage. Okay. And so when there is a covered claim on the association policy and there could be a really high deductible on the association. Let's say there's a $20,000 deductible. That means that if this homeowner or this unit owner has a claim and that association policy isn't even going to start coverage until that $20,000 deductible is met. And so it's a $50,000 claim. Now that deductible is assessed to the unit owner, and that's where loss assessment comes into play. Traditionally, it's always been about $10,000 in loss assessment coverage. The most deductible, highest deductible you'd see is $10,000. Now it's going up $50,000. These percent deductibles on wind and hail, and that loss assessment coverage is more important than ever. And then there's the hard part where not many insurance companies even offer that high a coverage. If I write 15 different condo insurance policies, maybe 5 of those we can find to get up to that coverage amount. So,
do you think that'll grow with how things are going, or?
Something has to give, but it's also a lot for these insurance companies to take on. So it's always this balance of how long it takes to figure out how to price their policy correctly to be able to offer that increased coverage.
Sure. And I suppose it depends on the size of some of these agencies too, and
the companies, and how quickly they can get any changes through an insurance. And that's why we're seeing, a lot of these rate increases too, because policies aren't properly priced for all these losses and claims we've had in Minnesota. And, so they just kind of put on these, across the board rate increases.